Okay, so basically what happens, I thought we'd cover in more detail some of the empirical tests of the EMH and what does the research actually show us about the efficient market hypothesis, and how do we actually come to the conclusion that markets are semi-strong form efficient. So what happens is that how do we test it, right? So we actually look at these weak form tests where we actually analyze patterns in stock returns. Okay, so we do look at things like returns over short horizons, and we do find that there's this thing called the momentum effect, right? That poor or well-performing stocks tend to continue their abnormally poor or strong performance in the following periods. So that's where these are the weak form of market efficiencies. We also find that over a long horizon, there's a reversal effect whereby poor or strong performing stocks tend to experience reversals in following periods in the long term. So these are the weak form tests where you find these patterns in stock returns, right? So basically what happens if markets are truly efficient, we shouldn't see any patterns, but we do find a momentum effect and a reversal effect. Okay, so basically what happens is that other findings from research papers are in Farmer and French, Campbell and Schiller, and Kime and Stumbaugh, where they actually find that if it's true that markets are truly efficient, then we can't predict any of them, right? But we actually do find like instances by Farmer and French where the return on the aggregate stock market tends to be higher when dividend yield is low. Okay, so this is consistent when shareholders receiving low dividends, right? Then the return on the stock market tends to be higher, potentially because they're actually investing more into growing the company, making investments. Okay, so Campbell and Schiller also find that earnings yield can predict market returns. And obviously, like what happens is that Kime and Stumbaugh find that bond market data, like yield spreads, can predict market returns as well. So basically, if markets are really strong function, there should be no patterns and no way to predict prices, but we do find certain versions of predictability that they are predictors of broad market performance. Maybe not for specific stocks too well, but broad market performance. Okay, so the other semi-strong tests are market anomalies, where we find patterns of returns which contradict EMH, where there are patterns of returns. So one of this is the PE effect, that we find that portfolios with low price to earnings ratios exhibit higher average risk-adjusted returns than high price to earnings stocks, right? So what we actually do over here, we actually would, to perform these tests, we actually take the whole universe of stocks, we turn it into deciles, which means we take the top 10% and the bottom 10%. So we take all the stocks in the stock market in a certain period. We actually sort it according to price earnings ratios, where the top 10% has the high PE and the bottom 10% has low PE. Then we'll create a portfolio that's self-funding by actually doing something like shorting the low PE stocks and going long on the high PE stocks and actually tracking the performance of the portfolio over time. That's typically how we actually do market research. We want to test for market anomalies. So what we actually find is that portfolios of low PE stocks exhibit higher risk-adjusted returns than those with high PE stocks. Other market anomalies we find are post-earnings announcement price drift, whereby it takes time for a stock price to actually respond to a firm's earnings announcement. Okay, so what happens if stock prices reflect information and it's immediate? Why is it taking such a long time? So there's a normal return on the announcement day, but the momentum continues past the market price. So we do see a price adjustment, but why does it continue to keep growing past the market price? Why doesn't it actually just reflect it completely and actually just go sideways at that point in time? We usually find the evidence of bubbles, financial bubbles, where speculative bubbles can raise prices above intrinsic value, which is like the housing market, which is like cryptocurrency. And so sometimes, even if prices are inaccurate, it's difficult to take advantage of them. Okay, an example of a speculative bubble was what happened during the global financial crisis, where it's a speculative bubble on real estate and collateralized mortgage obligations, which was shown in The Big Short. So this is where we see like an example of what happens. The company has actually announced like a takeover, right? So we look at the target company. Okay, so prior to the announcement of the takeover, right, we can actually see that the stocks have been quite stable. Suddenly it starts to go up, then it's a huge jump. So what happens is that if there is no insider trading, we would expect there would be no cumulative abnormal return all the way up to the point in which it's announcing date, and then it goes up. But we actually see evidence that some information is leaking out because there is evidence of abnormal return to that stock prior to the announcement of the takeover date. But yes, during the takeover date, it jumps up significantly and it flatlines and it goes up a little bit. So this evidence, this over here shows evidence of some form of insider trading, because this shouldn't occur if markets are truly efficient. So let's look at earnings announcements. Right? So what happens, I talked about the fact we actually look at deciles where 1 is the worst and 10 is the highest. So what we're saying over here, we take all the stocks in the universe, in the SP 500, for example, and we sort it into deciles, which is the top 10% having the highest earnings surprise, and the bottom 10% having the lowest earnings surprise, which is at 1. Okay, so this is 0 when the announcements are made. Okay, so what we see over here is evidence that before the earnings announcement is made, for the poor performing stocks, we see them start to drift downwards. So this is kind of evidence of some form of private information or anticipation that earnings are going to be bad. Okay, then when they make the announcement and it is actually quite bad, what we actually see is that there's a sharp decrease, but it still continues onwards. So why is this post-earnings drift? Should it just go down all the way down to here? Why does it have to drift downwards? And why does this actually have to drift upwards? Shouldn't it just be a sharp spike upwards? So basically that's what we're referring to when we talk about post-earnings announcement drift. Okay, as we talked about here. Okay, so abnormal return occurs on announcement day, but momentum continues past market price. So realistically, we shouldn't expect to see this drift. We should see this sharpward spike, and then it would just stay flatline all the way throughout. Okay, so these are indications that markets are not quite that efficient, and information takes time to be processed. Okay, so let's look at another one, right? So this is stock price reaction to CNBC reports. Okay, so what happens is that we're looking at minutes, not even days, but cumulative return to a stock, right? So what happens, what we see over here is that when the report is actually made on something positive, we'll actually start to see it go up slightly, and even more so right after, and it comes back downwards. Okay, so what is this evidence of? This might be evidence of the fact that some information is leaking out to the market. Okay, so if the information is negative, we see it's asymmetric, right? That what happens over here is that the cumulative return to that stock goes up to about between 0.0.75, whereas over here it shoots down and goes quite aggressively to about almost -1. So in this, we can actually see there's some evidence of the fact that we react more negatively to bad news than we do to good news. And that's reflected in the stock price. And we saw evidence of the fact that, we react to negative news earlier, all right, and more significantly as well. So are markets efficient based on what we've seen? Okay, we've also seen other anomalies such as the small firm effect, such that stocks of small firms earn abnormal returns, especially in January. We also see that neglected firms, where stocks of little known firms can generate abnormal returns. That can kind of make sense because basically neglected firms means that information is not quite efficient in those areas. So basically, since not much is known about them, we can actually purchase them and get abnormal returns. We also see evidence of the book-to-market effect, which is part of the Farmer-French three-factor model, that the shares of high book-to-market firms can generate abnormal returns. So often the argument for this is because these are often safer firms, are perceived to be safer because of high book-to-market value. So how do we interpret all these stock market anomalies? Are they risk premiums or inefficiencies? Okay, so what happens, Farmer and French Nobel Prize winners argue that these market phenomena are manifestations of risk premiums, Whereas Lakartashik, Shively, and Vishny argued that these market fundamentals are evidence of inefficient markets. So basically, you could actually argue that even in the academic literature, it's not quite settled whether these efficiencies come from risk premiums or inefficient markets. Okay, so as talked about before, all right, this actually shows us that it actually informs us what does it take to actually be a portfolio manager. Okay, it takes a lot of effort, or you can take the easy path and actually invest in passively in index funds. So if we have a fully efficient market where all information is correctly reflected in the price, this actually means there's no need for research, no need for analysts. So then how do prices incorporate new information? So that's why this is a paradox. Market efficiency itself is really a paradox, right? Because we talked about arbitrage opportunities. In order for there to be arbitrage free, arbitrage options have to exist and must be taken advantage of. So basically, it's a paradox. So with that, I hope we've given you some examples of the stock market about why we actually argue about whether or not markets are truly efficient and that efficient itself can be seen as a paradox.